Good morning, members. This is the appointed time and we have a quorum, so I call this meeting to order. This is the Bills Committee on Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024, and this is our second meeting. Let me ask the Secretariat to invite the administration to come in. We are joined by Mr. Lai and Mr. Chen from Mr. Benjamin Chen, Commissioner for Inland Revenue from the administration, and we have received 10 written submissions. They've been forwarded to members for reference, and we have also received a response. Now, there are 3 papers issued. TsyB R2/322/2025-01, a list of follow-up actions arising from the last meeting, and also the response. TsyB R2/322/2025-02, administration's response, and also a response paper TsyB R2/247/2025-01. Another response paper from the administration. I will ask the administration to walk us through the response paper to questions raised last time. Who will take us through this paper, please, Mr. Lai? After the first meeting, we issued 2 response papers. The first one relates to the response to issues raised by PwC, and also in relation to the requests raised by members at the last meeting. We issued another response on the 19th of February. So I'd like to highlight 3 points in the response dated the 19th of February. Because of the various scenarios that may be involved, we have prepared 4 diagrams to explain the application of the various rules and changes in our taxing rights, and we will take members' further questions in relation to these diagrams, if any. The other point is about the peer review process of the OECD and the effect or implications. As explained in the paper, because of the international tax cooperation requirements, the OECD has demanded all members under BEPS 2.0 to follow the OECD requirements. And to make sure that these requirements are met, the OECD has put in place a peer review mechanism. That means for participating members or regions, they will take part in a peer review of the situation regarding one another. In other words, for a jurisdiction that has put in place the global minimum tax regime, and yet in actual implementation there is a breach of the 15% top-up tax arrangement, then other member states may declare the arrangement void and that they could charge top-up tax in relation to particular enterprises. So there is a need to follow the OECD requirements. The third point, as mentioned in the last meeting, is that the new arrangement may affect about 200 MNE groups headquartered in Hong Kong. Now, regarding their accounting period, as we can see, close to 85% of them had end dates of accounting periods falling on the end of December. So the minimum top-up tax arrangement will come into effect on the 1st of January 2025, and that means for MNE groups or their member constituents, if adjustments are to be made in relation to the fair value accounting of the assets, then there is still sufficient time for them to do so. So that's the response. And in relation to our other response dated the 14th of February, we explained the concerns raised by EY Ernst & Young, and that's a main purpose test as well as the liabilities of the relevant personnel. We've given a response. Basically, our legal framework follows the minimum requirements imposed by the OECD. In drawing up this bill, we consulted the stakeholders concerned, including the MNE groups or major accounting firms. In light of their concerns, we are now actively considering some amendments to particular provisions of the bill, and will be reporting to the Bills Committee in due course. Perhaps I'll stop here, but we welcome follow-up questions on policy issues from members. Myself and the Commissioner for Inland Revenue will be happy to take these questions. Now, there are 4 diagrams, and I'd like to go to the first one. I see that is Hong Kong constituent entities of Hong Kong Group. In Chinese, there is a typo. It should read 實體 instead of 成員體. So that's from me. I'd like to know if there are questions from the floor. If not, then we'll come to the clause-by-clause scrutiny stage, and by then we will be able to put these questions to the administration or to the legal advisor for a response. So any other questions on policy issues? If not, we now start the clause-by-clause scrutiny. Who will take us through this bill, please? Ms. Lam. Ms. Florence Lam, Assistant Commissioner from the Inland Revenue Department, would you please walk us through this bill, please? I will now take members through the content of the bill, and I will be making use of the marked up copy. So for the long title, that's the first thing I'd like to go through. And I'd like to ask members to go to C4307. That's the long title in the blue bill. It reads, a bill to amend the Inland Revenue Ordinance to implement the international tax reform proposals to address the base erosion and profit shifting risks arising from digitalization of economy by introducing global minimum effective tax targeting certain large MNE groups, and also to implement a domestic minimum top-up tax for the purpose of safeguarding Hong Kong's taxing rights on those groups and members, and also to make minor miscellaneous amendments. Now we come to the first clause of the bill. It sets out the short title and commencement. This ordinance may be cited as the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Ordinance. Subject to subsection 1(3), this ordinance comes into operation on the day on which it is published in the Gazette. And then subsection 3, in relation to the determination of tax resident, that is subsection 3 is deemed to have come into operation on the 1st of January 2024. Clause 2, Inland Revenue amended. That is, the ordinance is amended as set out in sections 3 to 16. For 16, 4 schedules will be added from 60 to 63, in other words, and we will come to that in a moment. I'll give you more details. We now go to clause 3 of the bill, and that is pages 1 to 5 of the marked up copy. We're going to amend certain definitions of terms in the ordinance, and that's Cap 112. For service provider, we are adding subsection 2D, and that is for in-scope MNE groups. They could engage service providers to file tax returns or notices. So that's the addition to the definition. And as for profits tax, it says that subject to paragraph B, profits tax under tax 4 and top-up tax under part 4AA are regarded as profits tax. As for top-up tax, it means IRR top-up tax, UTPR top-up tax, and Hong Kong minimum top-up tax. We now turn to page 5. That is a new definition for the term tax resident. Now, in order to meet the objective of introducing the Hong Kong minimum global top-up tax, and also to determine and to meet the globe rules, we add this definition. An entity is a tax resident in Hong Kong if the entity is a company and it is incorporated in Hong Kong, or if incorporated outside Hong Kong, normally managed or controlled in Hong Kong. Or in any other case, say if the entity is constituted under the laws of Hong Kong, or if otherwise constituted, normally managed or controlled in Hong Kong. Now, if the bill is passed, this provision will come into operation on the 1st of January 2024. As explained in the previous meeting, for some jurisdictions, they introduced the globe rules in 2024. So by introducing this provision, we can minimize the exposure of MNE groups to top-up tax in other jurisdictions. Now we come to clause 4 of the bill, and that's pages 6 to 8 of the marked up copy. If we turn to page 8, it provides an amendment to the Official Secrets Ordinance. So that's under official secrecy in section 4. There is a rule, and the Inland Revenue Department or the officer must not communicate to any entity and disclose personal data to any other party. But then we have subsection 7 added, which means that when it comes to top-up tax, the Inland Revenue Department may communicate to any entity or permanent establishment of the group any matter that comes to the knowledge in relation to the implementation. However, it should relate only to the determination of the amount of the top-up tax payable or chargeable, or performance of duties under the ordinance involving top-up tax. Say the MNE group may designate an entity to file the top-up tax return on behalf of the MNE group, or that the MNE group may appoint one or more entities to pay the top-up tax on the group's behalf. Clause 5, pages 9 to 11. You'll find the amendment in page 9 of the marked up copy, and that's a miscellaneous amendment. In relation to section 14 IM 3 of the Inland Revenue Ordinance, we propose to adopt the calculation here, and that is about calculation of net payments of finance charges or interest for funding leases. And you can see that the correct formula should read D plus E plus F. And then next, from 12 to 14, we propose to amend section 16(1)(c), and we are going to add 2L. It reads that the subsections 1C and C8 does not apply in relation to top-up tax paid in the territory outside Hong Kong under the rules within the globe meaning of the globe rules. That means for an entity that has paid the top-up tax under such circumstances, there is no deduction.
Clause 7. We have added Section 25A after Section 25, and this is in relation to reimbursement for top-up tax not taken into account for purposes of Part 4. If such taxes have been refunded or reimbursed, when paying profits tax under Part 4, that payment cannot be deducted. Excuse me, can you stop here? Ms. Lam, we have we're about to go into Part 4AA. Let me clarify with members if they have any questions to ask now. If not, please proceed, Ms. Lam. Thank you. We're now on Clause 8. Pages 45 to 51 of the marked up copy in Chinese. We have added a Part 4AA. This is new. It will add 26AD to 26AH. At the beginning of Part AA, we have added some notes. This is not legally binding. This is quite complicated. That's why we have provided notes. Essentially an overview of the operations. We have added Section 26AD, page 47 in the Chinese marked up copy. We have given some definitions on OECD documents. For example, on page 47 in the Chinese marked up copy, we have the definition of globe rules. In Schedule 60, Part 1, we have some rules, and these are the globe rules. Basically, we have incorporated the globe model rules in Part 1 of Schedule 60, except for necessary adaptations. We have other definitions, including some references to OECD documents, such as the commentaries, guidance. We have included them in Part 1 of Schedule 63. We have also included some, well, that's about it. The papers referred to in the schedules. Let's go to page 49 of the marked up copy in Chinese. It is charge of top-up tax under IIR and UTPR and charge of domestic minimum top-up tax under HKMTT, Section 26AE. That would cover in scope MNE group's income. They must pay at least 15% in effective tax rate. Under globe rules, we have some transitional and permanent safe harbor provisions. They will be included in Part 3 of Schedule 60. Regarding MTT-related provisions, it will be found in Schedule 61. For the detailed operations, they will be found in Schedule 62. Now let's go to subsections 6 to 8. It says that the relevant top-up tax is payable in relation to a fiscal year beginning on or after 1st of January 2025. That's the case for IIR and HKMTT. For UTPR top-up tax, it is payable in relation to a fiscal year beginning on or after a date specified by the Secretary for Financial Services and the Treasury by notice published in the Gazette. That notice will be subsidiary legislation. On to Section 26AF. Consistency with the OECD Globe Rules documents. The top-up tax under Part 4 will be given effect to in a way that supplements and clarifies the interpretation and operation of this part of Schedules 60, 61, and 62, and that is also the case with the OECD Globe Rules and the OECD Globe Rules Guidance. Next, Section 26AG. Power to amend definition of OECD Globe Model Rules and Schedule 60 to 63 by notice published in the Gazette by the Secretary for Financial Services and the Treasury. Section 26AH. We have introduced a main purpose test so that under the relevant top-up tax provisions, we have anti-avoidance provisions. If a person enters into any arrangement and the main purpose or one of the main purposes of the person in entering into such arrangements is to avoid any obligation under this part, it will be the case that the arrangements would be seen to not have been entered into. Alright, any questions from members? Legal advisor, if you have anything to remind members of, you can raise that at that point. Thank you. Please proceed, Ms. Lam. Thank you. Clause 9. Pages 52 to 56 of the Chinese marked up copy. This is about this sets out clearly, well, it amends Section 50. Tax credits under double taxation arrangements. To avoid doubt, no top-up tax payable under the NIIR or UTPR may be allowed as a credit under this section. Next clauses 10 and 11. Pages 57 to 70 of the Chinese marked up copy. Now, these are miscellaneous amendments. On the country-by-country reports, we have referred to some official documents. We have amended the relevant dates of the publication of such documents here. Next, clause 12, page 71 of the marked up copy in Chinese. In part 14, we have added a new section 79A on offenses relating to Schedule 60, 61, or 62. New offenses. We have introduced a definition of Part 4AA entity. Basically, the definition would cover some entities of in-scope MNE groups, including Hong Kong constituent entities and Hong Kong partnership enterprises and some joint venture groups. Next, clause 13. Pages 72 to 77 of the marked up copy in Chinese. In part 14, offenses and penalties, we have added new sections ATO to ATR that relate to some new liabilities rules in Schedule 60 to 62. There are some new offenses also. Let's first look at section ATO, page 72 of the marked up copy in Chinese. Offenses by Part 4AA entities, if they have no reasonable excuse, if they have not followed a requirement of a notice given to it under Schedule 62, if they haven't conformed to what is said in Schedule 62, filing a tax return, a notice, or providing relevant information in compliance, or without reasonable excuse, they have provided misleading, false, or inaccurate information that will constitute an offense, the proposed penalties are in line with offenses of not filing a tax return or inaccurate profits tax return. Let's move on to page 74 of the marked up copy in Chinese, section ATP. Section ATP is our minimum tax for MNE groups offenses by service provider for Part 4AA entities. Their related service providers, if they do not comply with the requirements, what penalties there are. So say if they have not filed a top-up tax return or a notice required, or they did not, or they filed misleading, false, or inaccurate tax returns on behalf of a Part 4AA entity, the proposed penalties are in line with those who are engaged by taxpayers to submit profits tax returns under Part 4. Moving on to Section 80Q, page 76 of the marked copy in Chinese. This sets out minimum tax for MNE groups, offenses by directors, etc. of Part 4AA entities and service provider. The penalties are in line with Section 80I of the Inland Revenue Ordinance on offenses relating to country-by-country reporting. Next, 77 of the marked copy in Chinese, a new Section 80R, miscellaneous provisions for certain offenses, including for the deadline of raising litigation and that we can have people pay fines in lieu of prosecution. Next, Clause 14. Pages 78 to 81 of the marked copy in Chinese. It amends Section 82, penal provisions relating to fraud, etc. We propose to add a new Section 82 1AA-D and subsection 1B. If someone with intent to evade top-up tax provides information that is misleading, false, or inaccurate in a material particular, or submit in a notice that is omitting any information that will constitute an offense, the proposed penalties are in line with Section 82, subsection 1 of the Inland Revenue Ordinance on providing misleading or inaccurate information, or you have omitted some information. Excuse me, can you pause here, Mr. Dan Sloan? Thank you. I want to go back to Section 80R. So if one commits an offense, the commissioner may compound an offense, having fines instead of prosecution. Who is going to determine the fine levels? Commissioner, will you answer this question? Mr. Benjamin Chen. Thank you, Chair. The member's question is on the compounding of offenses. In the Inland Revenue Ordinance, we have all along had related provisions. The principle is that if the commissioner considers the situation appropriate, they may compound an offense, so fines will be imposed. We will refer to the penalties if it's an offense that requires prosecution. In general, how much a taxpayer will be fined, there will of course be a cap, and this will be on a case-by-case basis. Any follow-up questions from Mr. Dennis Leung? The commissioner will determine the fines with reference to past cases, right? Mr. Chen. Correct, it is the case. Thank you. Please proceed, Ms. Lam. Thank you. We're now on Clause 15. From all the way to page 91 of the marked copy in Chinese, it amends Section 82A, additional tax in certain cases. We will add a subsection 1L to 10. So for Part 4AA entities without reasonable excuse fails to comply with sections in Schedule 62, haven't filed any returns or notices, or have filed information on notices or returns that are misleading, false, or inaccurate, and if there is no prosecution, the person is liable to be assessed under this section to additional tax. This is an administrative penalty. The additional tax will be in line with Section 80A of the Inland Revenue Ordinance if one is subject to additional tax under that provision on profits tax under Part 4.
16
Clause 16, adding 4 new schedules. Schedules 60, 61, 62, and 63. I will go through each of them. Schedule 60, there are 3 parts from 0092 to 0225 on the marked up copy. Part 1, that's starting from page 92 to 220, altogether 130 pages or so. Now, as explained before, we are directly incorporating the globe rules into the Inland Revenue Ordinance. The purpose is to get the qualified status in the peer review process of the OECD members. However, we have omitted a number of articles. In part 2, we are going to provide a supplementary note. We also have provisions in relation to the implementation of Hong Kong minimum top-up tax, and you'll find the relevant bits in Schedule 62. I'll briefly go through the globe rules. There are altogether 10 chapters under globe rules. Chapter 1 provides some definition of some basic terms. For example, in scope MNE groups, the income threshold, the definition of a group, and also ultimate parent entity, etc. For Chapter 2, please go to pages 97 to 103. This is in fact the crux of the globe rules, including the application of the IIR and the UTPR. The purpose is to apply the rules to the constituent entities of the ultimate parent entity that is outside the original jurisdiction, such that top-up tax will have to be paid if the effective tax rate is below 15%. As for Articles 2.1 to 2.3, the jurisdictions with the ultimate taxing right will be where the ultimate parent entity is. And then Articles 2.4 to 2.6 refers to the UTPR. That means after applying the IIR, if there is still top-up tax to be charged, then the rules will take into account the number of staff of the entity in the jurisdiction concerned, as well as the value of the tangible assets involved. I have a question on 2.6.1 in relation to the number of employees as well as the total value of tangible assets. Now, there must be changes of the two figures year on year. So I'd like to know the criteria to be adopted in the calculation of these two figures. That is in Article 2.6.1. According to the globe model rules, there are clear definitions in relation to the number of employees and the value of tangible assets and how the calculation should be made out. That means they take the average of the relevant numbers at the beginning and the end of the year. So that applies to both figures, right? The first day of the financial year, you look at the number of employees, and then you look at the same number in the end of the financial year, and you take the average, right? Any other questions? Ms. Lam, please continue. Chapters 3 to 5 of Globe Rules. these relate to the calculation of the effective tax rate. Now, as we explained before, for a constituent entity in a certain jurisdiction, all taxes paid by the entities should be taken into account to come up with the effective tax rate, but it's rather complex. Chapter 3 relates to the computation of global income or loss. Now, simply put, the starting point is to determine the financial accounting net income or loss for the constituent entity, and then it also takes into account the necessary consolidation adjustments in coming up with the effective tax rate. Now, if we go to Article 3.2 on page 105, adjustments to determine the income and loss. One of the adjustments is excluded dividends. That means you can exclude the dividends from determining the global income or loss. Now, that means for short-term dividends, for dividends from shares held in the portfolio for a short term, it will be excluded. And in other words, for entities holding 10% of the ownership interest or shares, then the dividends deriving from the ownership can be excluded. The other is excluded equity gain or loss. And that means for gains arising from changes in the fair value accounting for the equity in the portfolio, then again the gain or loss can be excluded. Article 3.2.5 and 6, as explained before, under global model rules, there are special arrangements on considering the asset gain, and that computation can be made for the asset gain can be included or considered in proportion so as to minimize the effect of the effective tax rate. Sorry, Ms. Lam, I have a question on 3.2.8. Now, if there is a constituent entity in the same jurisdiction, and if it's considered to be a consolidation, then the entity may opt for the integrated computation approach. So it also provides a period of 5 years. If there are changes to the constituent entity structure within the 5-year period, then will it be considered within the period, or must the adjustment be made at the lapse of the 5 years? The ultimate parent entity may elect to take an approach, and that is the election will be good for 5 years. What about changes happened meanwhile? Now, basically, the election under this article cannot be changed again. So once you've elected to adopt a treatment, that you cannot change that in the interim. Yes, the answer is yes. Right. Please continue, Ms. Lam. Chapter 4. From 120 to page 133 of the marked up copy, It relates to the computation of adjusted covered taxes. Now, we talked about the tax rate and the effective tax rate, but certain adjustments will have to be made. Now, when it comes to Chapter 5, that's pages 133 to 134, it sets out the computation of the effective tax rate. It will be based on the jurisdiction, and all constituent entities and the taxes paid will be added together. And then if we turn to 5.2, that is pages 134 to 136. You'll find the formula here, and that is jurisdictional top-up tax. Towards the end, you'll see that domestic top-up tax is deducted. That means if top-up tax is charged by the jurisdiction domestically in line with the OECD requirement, then the domestic top-up tax will be taken out from the jurisdictional top-up tax. So gaining the qualified status is very important, because if we charge the Hong Kong minimum top-up tax, then the entity will not be exposed to the top-up tax under the IIR rules. Chapters 6 to 10 of Globe Rules, these are technical provisions and other miscellaneous requirements. Chapter 6 relates to corporate restructurings and the relevant rules. From pages 154 to 167, you will find Chapter 7. The provisions relate to tax neutrality and distribution regimes. This is usually applicable to overseas jurisdictions only. Chapter 8, that's pages 167 to 168 of the markup copy. It relates to administration. You will see that Article 8.1, 8.3 of the Globe Model Rules are omitted. The rules can be found in Part 2 of Schedule 2 or 26AF. For 8.2, these are safe harbors. We've adopted the Globe Safe Harbor rules, and again you will find the relevant rules in Part 3 to Schedule 60. Globe Rules, Chapter 9, page 169 to 174 of the marked up copy. These are transition rules. When a jurisdiction implements Globe Rules, it may have to deal with matters relating to losses incurred that have been carried forward, and there may be a need to make adjustments for the purpose of taxation. So this chapter sets out the rules. Now we turn to Chapter 10, marked up copy pages 174 to 202. It sets out very clearly the definitions of some terms under Globe Rules. Now we come to Part 2 to Schedule 60, and that is page 220, starting from page 220 of the marked up copy. It sets out the adjustments, that is in relation to computations under 2.6 or an Article 2.4 of the under-tax profits rule, and also adjustments to the top-up tax mechanism. Simply put, there are two ways of implementing the OECD requirements. Now, by adopting, say, the top-up tax approach under UTPR, the jurisdictions may allow deductions, and that the amount should be equivalent to the top-up tax. The top-up tax may also be charged as an additional tax. Now we set out that by adopting Hong Kong minimum top-up tax, we introduce the under-tax profits rules. We will charge minimum tax directly. The merit is that we'll be able to charge the tax immediately, and that no carrying forward arrangement will be allowed.
On 2.6, we talked specifically about for top-up tax. We will make use of the allocation mechanism under UTPR so that for Hong Kong constituent entities for an MNE group, we will refer to their respective ratios of number of employees and total value of tangible assets in allocation. Alright, any questions from members? If not, please proceed, Ms. Lam. Thank you. Now we're on part 3 of Schedule 60. Pages 222 to 255 of the marked up copy in Chinese. Some safe harbor provisions. We have transitional and permanent safe harbor provisions in sections 2 to 15 of part 3 of Schedule 60. Now, first, for transitional safe harbors for country-by-country reporting. For MNE groups, right now for country-by-country reporting, they have already submitted some returns or information. So for profit or loss before income tax, we will have that as a simple reference point. Basically, if an MNE group can refer to a simple standard to make sure they can meet the minimum profit tax or some effective tax rate test and for total revenue test, if they can pass the relevant tests with this simple reference, they will already be seen as having zero relevant profit, and this is what applies during the transitional period, a period that covers all the fiscal years beginning on or before 31st of December 2026, but does not include a fiscal year ending after 30th of June 2028. From pages 243 to 244 of the marked up copy in Chinese, we have another safe harbor for transitional CBCR. If it has a revenue not less than 20%, the effective tax rate would be not less than 20% during the transitional period for each fiscal year. For this 20%, it will be seen as that they would have zero tax revenue, and that would be fiscal years before 31st of December 2026. That would be applicable. We have some permanent safe harbors as well. Sections 19 to 28 of Schedule 3, QDMTT Safe Harbor. Basically, entities would have to meet the jurisdictional ETR when calculating relevant top-up taxes. To prevent situations where they have to repeatedly calculate QD-MTT and the local MTT. For a particular jurisdiction, if they are already charged top-up taxes, they will not have to pay another top-up tax with this safe harbor. Sections 29 to 37 of the schedule. We have some simplified calculations for safe harbor. These will only apply to non-important or non-major constituent entities of MNE groups. So that is basically, or non-material constituent entities. That's it for the safe harbors. Any questions on safe harbors? If not, please proceed. We are now on section 61. Or excuse me, schedule 61. Pages 256 to 269 of the marked up copy in Chinese. This is on HKMTT. Under the globe rules, for a jurisdiction, when the jurisdiction is discharging the domestic minimum top-up tax, it should align with the purpose of charging minimum top-up taxes. We basically need to conform to the globe rules closely unless it is allowed by the OECD to make adjustments or have our own choices. So say in section 3, page 259 of the marked up copy in Chinese, charge on Hong Kong constituent entities of MNE groups. In subsection 2, it says specifically for investment-related entities or insurance-related entities, they will not be covered under HKMTT regime. Sections 4 to 13 of the schedule are on HKMTT's framework under globe rules. Under what situations we have to make adjustments, modifications, and some technical details. The relevant rules are the same as those of the globe rules. Alright, so that is schedule 61. Any questions on this? If not, please proceed. Alright. I will now move on to schedule 62, administration of top-up taxes. The relevant pages are from pages 269 to page 305 of the marked up copy in Chinese. We first have some definitions and scope. And then in part 2, we have Hong Kong constituent entities' obligations to file top-up tax return and notice. And on the determination of liabilities. These will start from section 3 of part 2 of schedule 62. In section 3, it says that each Hong Kong constituent entity of an MNE group must file a top-up tax return in a specified form and within a specified period file a top-up tax return. And the relevant information must include a globe information return, in short, GIR information return. For each MNE group, they must submit a GIR information return. Now, section 4. Pages 273 to 274 of the marked up copy in Chinese. Assessor may require constituent entity to file top-up tax return. 1. Can issue written notice. By the filing deadline, the entity must comply with the requirement to submit a notice. But if the entity satisfies the commissioner that they have some conditions met, for example, they can provide information that they cannot meet the relevant MNE group threshold, they will be excluded. Pages 274 to 276 of marked up copy in Chinese, Section 5. Hong Kong constituent entity must file notice. They must file the notice in a specified form and way. A written notice to inform the commissioner of some information in respect of a fiscal year. That would include, for example, the designated filing entity for the GIR, or when a GIR is submitted in another jurisdiction, they would need to talk about which jurisdiction it is. And the filing liability would be within 6 months of the relevant deadline. And they will need to submit a relevant notice in any of the jurisdictions to discharge the liability of filing such return. Next, Section 6, Group Globe Filing. So if there is no designated filing entity, or the designated filing entity has filed a top-up tax return, they would be seen as having discharged such liability in Hong Kong. Or if they have submitted a GIR outside Hong Kong, and Hong Kong has an exchange mechanism with that particular jurisdiction, the entity would, or the group would be seen as having completed the relevant filing procedures. Please pause here, Mr. Dennis Leung. I want to talk about Section 5 on subsection 3. It talks about a notification deadline that is 6 months after the end of the fiscal year. And it has to be in a specified form. If the notification deadline falls on a holiday, do we have relevant arrangements to prevent any disputes from arising? Thank you, Mr. Chen. Thank you. On the submission of returns, in later provisions, we will set out some arrangements. We will require electronic submission, and the system is designated by the Commissioner of Inland Revenue. If the deadline falls on a holiday, what is going to happen? On Interpretation and General Clauses Ordinance Chapter 1, we already have a rule in there. If the deadline falls on a holiday, it will be moved to the next working day. Thank you. Thank you, Ms. Lam. Please proceed. Thank you. We're now at Section 7, page 280 of the marked up copy in Chinese. We talked about how there may be an exchange mechanism, and this Section 7 is on requirement for filing globe information return if exchange mechanisms fail. That is, if Hong Kong has not received the relevant GIR, the Commissioner may issue a notice to one or more Hong Kong constituent entities to ask the entities within 30 days submit the GIR. Page 281 of the marked up copy in Chinese, Section 8, Group Local Filing. For the MNE group, for filing a top-up tax return before the deadline, they have a Hong Kong constituent entity that has filed a top-up tax return. The MNE group has filed a top-up tax return in Hong Kong. Yes. Any questions?
Please continue. To page 282 of the marked up copy, Section 9, filing deadline. It provides for the filing deadline for the GIR tax return, and that is the date of expiry of 15 months after the end of the last day of the fiscal year. For the first transitional year, the filing deadline will be at the expiry of 18 months after the end of the last day of the first fiscal year. And then page 283, in relation to the GIR return, it must be filed in a standard template that is developed according to the global framework and must include some information as required. And then starting from page 284, as the Commissioner just mentioned, the in-scope MNE group will be required to make use of the designated platform and submit the top-up tax return and notice electronically. Now please pause here. It provides here that the submission can be made in a form specified by the Commissioner. I'd like to know under what circumstances the Commissioner may accept the filing of a return that does not meet the standard template requirement. Well, we've provided for exceptional circumstances. We've considered some possible scenarios. For example, an MNE group may only have one constituent entity and is a parent entity. So once this framework is implemented in 2025, this MNE group constituent entity will be required to complete filing locally. However, as mentioned by Ms. Lam just now, in the year 2025, the implementation begins and the deadline will translate to 15 months or 18 months at the end of 2025. That means 2027. Now, say if this company winds up in 2025, then from the Inland Revenue Department's perspective, they should file a tax return for assessment as quickly as possible. And under such circumstances, we consider that the actual platform will be rolled out only in January 2026. And in that case, there will be no alternative but to allow for filing of paper returns by the taxpayer. And that's why we have included this exception here, that the top-up tax return may be filed non-electronically. Page 286 of the marked up copy, other obligations. There are other obligations for the in-scope MNE group to provide accurate and complete information, for example. And then section 13, engagement of service provider. A service provider may be engaged for or on behalf of a Hong Kong constituent entity for, say, filing top-up tax return or notice. So that completes my introduction of part 2. We now come to part 3 of Schedule 62. In the Inland Revenue Ordinance, modifications will have to be made in order to introduce the top-up tax framework. For example, in sections 14, 15, 16, we provide for the modifications. For objection and appeal under the IRO, modifications will have to be made in relation to top-up taxes. Likewise, the same tax demand arrangements apply to the Hong Kong constituent entities of in-scope MNE groups. There are exceptions. As I mentioned, for example, in Part 9, we have exceptions in relation to the filing of tax returns because we already have specific provisions for top-up tax. Now I come to the actual modifications. Section 17, that's pages 290 and 291 of the marked up copy. Section 51C relates to business records to be kept. In order to ensure completeness or correctness or accuracy of the top-up tax return filed, we need to make modifications to Section 51C such that a Hong Kong constituent entity of an MNE group will need to keep the relevant business records in relation to the computation of top-up tax liability of the MNE group, and that the records should be kept until the expiry of 12 years after completion of the transactions, etc. Please pause here. Our legal advisor has a question. We earlier wrote to the administration, TsyB R2 111/2025-02. The question was raised, a hypothetical one, in paragraph 9. That is, where an in-scope MNE Group's Hong Kong constituent entity fails to keep business records in relation to the computation of top-up tax for the period between the 1st of January 2025 and the 1st of March 2025, and if it's considered as having contravened the record-keeping requirement, what will be the consequence? According to the administration's response, they will take a flexible approach to handling this issue. And then the Legal Service Division of LegCo further wrote to the administration on the 20th of February, and that's TsyB R2 231/2025-01. We invited the administration to further clarify the issue, that is, for a Hong Kong constituent entity of an in-scope MNE group which fails to keep business records between the 1st of January to March 2025, whether, if prosecuted, the prosecution will constitute retrospective imposition of criminal liability, which will contravene Article 12 of the Hong Kong Bill of Rights, and if so, whether the administration would consider providing for transitional arrangements to resolve the issue. In the latest reply of the administration, that's TsyB R2 247/2027-01, it is said that the administration will follow Article 12(1) of the Hong Kong Bill of Rights Ordinance. So my question for the administration is this. Would the administration please clarify how this will play out in actual implementation? How would you ensure that the Hong Kong Bill of Rights Ordinance will be observed? Thank you, Chair. There are two parts to this question. The first part is the business record keeping requirement. The second part is the penalty. Now, for record keeping requirement, our stance is this. The fiscal year in relation to the charging of top-up tax will has begun on the 1st of January 2025. So in computing top-up tax, we require taxpayers to comply with the business record keeping requirements so that documentary proof can be provided for the purpose of checking. Now, this is also a safeguard for the taxpayer so that in the event of tax disputes, they can show proof. That's the reason why we require the business records to be kept starting from the 1st of January 2025. We don't envisage difficulties to be encountered by taxpayers, because when it comes to the computation of top-up tax, we will base our calculation on the financial statements. For financial statements starting from the 1st of January 2025, taxpayers are not yet required to complete the financial statements yet. They are actually preparing for the financial statements in fiscal year 2024. They are, however, required to keep transaction records, because by the end of the year they will have to prepare for the financial statements of this year. So we believe that the taxpayers will not have any difficulty in keeping these transaction records. Now I come to the penalty part. Ms. Lam already explained just now that as far as the bill is concerned, there will be retrospective effect in relation to the definition of tax resident, such that the definition takes effect on the 1st of January 2024. Apart from that, for the rest of the bill, it comes into effect only after it has been passed. We explained that we have no intention of making the criminal liability provisions having any retroactivity. So in other words, the business record keeping requirement may relate to a period before the passage of the bill. And we've made our position very clear that in the event of non-compliance during the period mentioned, we are not going to impose any penalty. Right, if there are no further questions from the legal advisor, I will ask Ms. Lam to continue. Section 22 of Schedule 62, page 293 of the marked-up copy. Sorry, we were on section 20, that's page 292, about additional assessments for top-up tax. Section 60 of the IRO will be modified. Under section 60 of the current IRD, for additional assessment, the deadline is 6 years at the end of the fiscal year. However, for the computation of effective tax rate or top-up tax, the computation will be based on the income in the jurisdiction where it operates, and also the amount of taxes paid, and that there may be exchange of GIR with other jurisdictions. We need to modify section 60 to extend the deadline for issuing a notice for additional assessment. That means the deadline will be changed to the end of the fiscal year, or the end or the period when the assessor comes into knowledge of the undertaxed situation, or 6 years after that, whichever is shorter. The next one is page 293, section 22, about the period of objection. The deadline will be postponed from 1 month to 2 months after the notice has been issued. And then sections 23 to 27, they relate to modifications to other arrangements such as hearings, assessment. Next, section 30. Allocation of UTPR top-up tax or Hong Kong MTT in special circumstances, and that modifications will have to be made to the allocation. According to the arrangement at the moment, for UTPR, allocation will be made out according to the number of employees and the value of tangible assets, whereas for the Hong Kong MTT, it will be allocated according to each constituent entity. However, in some circumstances, then the companies winding up or the constituent entities winding up may be involved. So under these special circumstances, we need to make modifications in relation to location to make sure that top-up tax can be charged in full.
Section 31. UTPR top-up tax or HKMTT of SS Group may be paid by designated paying entities. So a group may make an annual selection to designate one or more paying entities for any UTPR top-up tax or HKMTT payment. This is to offer some flexibility to MNE groups so that they can make their own elections. As we set out that groups may designate paying entities, in Section 33, we have spelled out if the relevant designated paying entities default, the assessed group of MNE group concerned would have joint and several liability of paying the amount of the top-up tax in default. Alright, please proceed. Thank you. We're now on Schedule 63. Pages 306 to 331 of the marked copy in Chinese. You can see a table here. So it sets out up to now under the OECD Globe rules, the commentaries that have been published or guidance that has been published, and that is part 1. In part 2, we have a table. In columns 2 and 3, as you may have observed, we have some corresponding provisions of Globe rules and the OECD Globe model rules, which articles we have in our bill. And we have also set out the guidance and commentaries, the specific paragraphs we have referred to. When implementing the Globe rules under our framework, after the OECD has released the rules, they will have commentaries or guidance that may amend existing rules. So, to facilitate readers' reference, we would ask them to refer to the guidance or the specific paragraphs and commentaries to understand better the rules of the OECD. That is it for the clause-by-clause examination. Thank you. Any questions from members on the clauses? Mr. Edmund Wong. Mr. Edmund Wong, please turn on the microphone for Mr. Edmund Wong. Thank you, Chair. I want to ask about C4751 on 51C. Keeping records for 12 years. The Assistant Commissioner talked about this. Can you talk about why we would need 12 years for the records to be kept for that amount of time? Thank you. Thank you. Right now we have to have records kept for 7 years, but we know that with the Globe rules, and the HKMTT framework, we need to understand there are differences with the Hong Kong profits tax regime. First, with the return. For the minimum top-up tax return, as you may have heard us say during the clause-by-clause examination, it would be 15 to 18 months after the end of the fiscal year that we will receive such returns. And for some groups, the parent entities are not located in Hong Kong. The GIR would have to be transferred from another jurisdiction to us through an exchange mechanism. So by the time the Inland Revenue Department receives all relevant information, it would be already, say, 2 years afterwards, after the end of the fiscal year concerned. Which is why we need to extend the period of an entity keeping the relevant records. That's the first reason. And for the relevant top-up taxes, the difference between them and profits tax would be source-based. So say if a revenue is derived from business in Hong Kong, it would be chargeable. But then for top-up taxes, it may be the case that foreign revenue may be relevant. If the Inland Revenue Department has to make an assessment, they will need more time to collect relevant information to make the assessments. So with the assessment period and the period of time for keeping records, they have to be extended. But we have received submissions that have expressed concerns, saying that we should shorten the period of time. We have referred to practices in other jurisdictions to see if we need to improve the period of time. And when we address the submissions, we may propose changes to address the concerns raised by the deputations and individuals. Mr. Edmund Wong, I think I'll wait until their proper reply. I thought 12 years is a bit long. I think the commissioner may just ask the relevant entities to keep the records for longer. As for whether I'll propose any CSA, it will depend on their proper reply. Thank you. I know that some have concerns about the main purpose test and that we should adopt the sole and dominant purpose test instead. And I think the administration will address such in their reply to the submissions as well. Okay? We have completed the clause-by-clause examination of the Chinese text of the bill. Let me confirm with the legal advisor that there are no legal or drafting issues with the English text. Legal advisor, thank you. We haven't found any inconsistencies between the Chinese text and the English text, and apart from the issues we raised earlier, we have not found any legal or drafting issues. Thank you. Thank you, legal advisor. The administration will provide a response to submissions. We have therefore reserved a time slot on 18th of March, Tuesday, between 4:30 and 6:30 p.m. to deal with the relevant issues. But of course, after circulating the reply, if members think it is not necessary to have another hearing, I will cancel the meeting and the Secretariat will post a notice. Any other questions from members? If not, meeting adjourned. Thank you for your attendance.